Okay, so this video is also going to cover fair value adjustments and income tax effects, but this time we're going to focus on inventory, intangible assets, and contingent liabilities. So I'm going to jump straight into an example in this one and just focus on those three categories, all the more theoretical stuff that's necessary for this process I've explained in the previous two videos. Okay, so Ben Limited acquires QCO for $1 million on 1 July 2015. QCO's equity is comprised retained earnings $600,000 and share capital $200,000. All assets are at fair value except for inventory, internally generated brand name, and provision for bank guarantees. So the inventory is sold on 30 June 2017. The bank guarantee settled on 30 June 2017 for $60,000. Tax rate is 30%. Record all consolidation entries. So we start off with our acquisition analysis. So again, we need to calculate the BCVR for each of the assets and the one liability here at the bottom. So for inventory, that's fair value minus carrying amount multiplied by 0.7. So we've got fair value being 150,000 minus 70,000 gives us 80,000 multiplied by 0.7, it's 56,000. Here, 100,000 minus 0 is 100,000 multiplied by 0.7 is 70,000. And here our fair value is 50,000 minus the carrying amount of 0. So 50,000 multiplied by 0.7 is 35,000. But in this case, it is negative $35,000 because of provision for bank guarantee. It's a liability. And so liabilities reduce equity. And so that's why our BCVR is negative, because the BCVR is an equity account. And so we've got to make sure that any liabilities reduce equity. So then our acquisition analysis going on. So our payment was $1 million, less the sum of our BCVR, it's $91,000. Calculated here. So our retained earnings, $600,000 from the question. Share capital, $200,000 from the question. So when you go 1 million minus these three here, you get goodwill of $109,000. Okay, so we've done this elimination of the investment asset a few times now over the last few videos, so I'm not going to spend too much time. So obviously we need to eliminate the subsidiary's equity, so we're debiting retained earnings of 600,000 from the question, debit share capital 200,000 from the question. We need to debit the BCVR, so that's $91,000. I explained why at the end of the last video. And then we need to debit goodwill for $109,000. So we will credit the investment for $1 million to eliminate it fully. Okay, so now we're going to look at revaluing inventory. So we know from the question that the fair value of inventory is $150,000, but the carrying amount in the subsidiary books is $70,000. So that means we need to increase the value of inventory by $80,000. And the way we're going to do that is by debiting inventory by $80,000. So this will increase it from $70,000 to the fair value of $150,000. We're also going to credit the BCVR. So that's $56,000. The reason we're doing that is because if we were to sell the inventory at the fair value, then effectively it would be a gain of $80,000. And so that $80,000 would then be attributable to the owners, but they'd have to pay tax on that gain. So the net amount that their equity would be increased by would be $56,000 after the tax is paid. So the remaining $24,000 is a deferred tax liability because we haven't actually sold the inventory yet, so there's actually been no gain that has been realized. But we know that if we were to sell the inventory, we'd have tax to pay in the future when this gain was realized. So So then in the year of sale, the entries are a little bit different. So we know that our inventory asset on the balance sheet is recorded at cost. So the amount of the inventory asset is actually equal to the amount of the cost of goods sold. So in the year of sale, we need to debit the cost of goods sold by $80,000 because the subsidiary would have only, so if the subsidiary sold all of their inventory, and we're assuming that in this example, then they would only have recorded COGS of $70,000, which is equal to the carrying amount of inventory on their balance sheet. But because we need to recognize the fair value of inventory at $150,000 on our consolidated balance sheet, then when we sell all of that inventory, we will need to increase the COGS by $80,000. So we have the $70,000 of COGS from the subsidiary, plus the $80,000 increase in COGS that we've made as an adjustment. So that will get us to the total COGS of $150,000. So we will then also credit our income tax expense. I've done it out of order. We'll credit BCVR first because the owners will always be entitled to that increase in equity when we revalued the inventory. So it's the revaluation amount minus the amount of tax they would have paid on that gain. That's $56,000. We'll also credit income tax expense because by increasing COGS, we've increased the expenses of the group, which means we've reduced profit. So we've reduced the amount of tax we need to pay, and that's why we're crediting income tax expense. Okay, so now we'll move on to the year after sale. So in the year after sale, what will happen is we will need to make an adjustment to the opening balance of retained earnings, and that will be for $56,000. Now the reason we do this is because in the year of sale, we increased our expenses through cost of goods sold by $80,000, and we also reduced our expenses by $24,000. So the net amount of this is $56,000 that we actually increased our expenses, but because both of these are expense accounts, they are closed to retained earnings at the end of the year. So for the subsequent years going forward, we will need to make this adjustment to the opening balance of retained earnings. And then we will also credit BCVR. As I've said, the owners will always be entitled to that increase in equity from when we revalued the inventory originally. Okay, so now we're going to move on to revaluing the brand name. So because the brand name was internally generated, the subsidiary is not able to actually recognize it on their own balance sheet. But because we have now acquired the company, we can recognize the brand name of the subsidiary. So we know that the fair value is $100,000, but it's carried for $0 on the subsidiary's balance sheet. So what we'll do is we'll debit the brand name by $100,000 to increase its value to its fair value. We'll credit BCVR by $70,000 because if we were to sell this brand name, it would be a gain of $100,000 because we'd be taxed on that gain. The owners of the company would only be only be entitled to $70,000 profit after tax. So we only increase the equity by that amount. And we'd also credit deferred tax liability because we haven't actually sold the asset yet. So there is actually no current tax liability. But if we were to sell the asset, there'd be a tax liability in the future. And so that would be deferred. Okay, so that's the first entry. The other thing about the brand name is that it has a useful life. The question tells us it's 20 years. this means that we need to amortize the brand name. So the fair value is $100,000, has a useful life of 20 years. That means our amortization expense will be $5,000 per year. Because the subsidiary doesn't recognize the brand name on the balance sheet, they won't be amortizing it at all. So we will need to recognize the full amortization expense in our consolidation adjustment. So we will debit amortization expense by $5,000, and we will credit accumulated amortization by $5,000. Now we'll also need to record the tax effect of this amortization expense. So the way we're going to do that, we'll be debiting deferred tax liability by 30% of the $5,000, which is $1,600, and we will credit income tax expense by the same amount. So the reason we do this is because the subsidiary will not be recognizing any amortization expense at all for this brand name. So by recognizing this $5,000, we'll be reducing the profit by $5,000, which means we'll have to pay less tax. We'll be paying $1,600 less tax, and so that means we need to reduce our income tax expense by $1,600. The reason why we're debiting this deferred tax liability is because that up here, before this amortization expense, if we were to sell the brand name, we would have made a gain of $100,000, and so 30% tax on that would create a deferred tax liability of $30,000. However, after this amortization expense, the carrying amount of the brand name is only $95,000. So if we were to sell it at that point of time at $95,000, then the gain would only be $95,000, and so 30% of that $90,000 would only be $28,400, which if you add up the debit to the deferred tax liability and the credit to deferred tax liability, that equals the $28,400. And so that's why we're debiting that here. So that was for 2016. So for 2017, this first entry is exactly the same. This is just revaluing the brand name. So what we do need to be careful is the amortization expense. So what will happen is we will recognize our amortization expense for this year, which would be another $5,000. But we also need to recognize the amortization expense from last year. However, because amortization expense is close to retained earnings at the end of the year, we will need to recognize last year's amortization expense by adjusting the opening balance of retained earnings. So we'll adjust opening balance retained earnings by $5,000, and then we'll credit accumulated amortization by $10,000. So again, we'll need to record the tax effect for this. So we'll debit deferred tax liability by $3,200. All right. We will credit the income tax expense by $1,600, and we will credit retained earnings opening balance by another $1,600. So the reasoning that we're crediting the income tax expense by $1,600 is because we're recognizing $5,000 more expenses that the subsidiary wouldn't have recognized. So this reduces the profit by $5,000, and so that means we will save $1,600 of tax because the subsidiary would not have recognized this expense, And so by recognizing the expense, we've reduced the profit, so we'll be paying less tax by that amount. Because we had, again, that amortization expense from last year, that expense has been closed to retained earnings. And so the income tax reduction was also closed to retained earnings. And so that's why we need to make this credit adjustment to the retained earnings opening balance. And then our deferred tax liability, as I explained in the last slide, because after the 2 years of amortization, the carrying value of the brand name will only be $90,000. So if we were to sell that brand name at this point in time, the gain would be $90,000, and so a 30% tax on that gain of $90,000 would come to $26,800, which is the balance when you take the debit of the $3,200 away from the credit of $30,000 of the deferred tax liability. Okay, so now we're going to look at revaluing the contingent liabilities. So in this case, it is the provision of the bank guarantee. So if we look back at the question, we know the provision of bank guarantee, the fair value is $50,000. So we calculated the BCVR on that to be $35,000. So what we're going to do is, because it's a liability, the way we're going to be increasing it is crediting it. So we'll be looking to credit the provision for the bank guarantee, right, by $50,000. So that will increase the liability on our balance sheet. And we know that the BCVR was $35,000. And because this is a liability, we need to reduce equity. And that's why we're debiting BCVR. And then we also need to debit a deferred tax asset. Now, the reason it's a deferred tax asset is because the tax base of the liability is less than the carrying value of the liability. So in this case, we're taking the tax base as the amount which is recorded on the subsidiary's balance sheet, which is 0, but the carrying value of the liability on the group balance sheet is $50,000. So the tax base is less than the carrying value, so it's a deferred tax asset. So then 30% of 50,000 is 15,000, which is our deferred tax asset. So that's how we revalue the provision for the bank guarantee. So in 30 June 2017, this is the year of settlement, as you could call it, for the guarantee. So we know that from the question, the guarantee was settled for $60,000. So we always start off with just our BCVR. It's always going to be the same, effectively. So the reduction in equity is always going to be at $35,000. Now, because we expected the guarantee or the liability to be $50,000, but it actually turned out to be $60,000, we need to treat this as a loss on settlement, effectively. So we'll debit the loss on settlement by $10,000. Right, so because we expect it to be $50,000, if, say, for example, it ended up being $40,000, then we'd credit a gain on settlement for $10,000. Now, we also need to debit an income tax expense of $15,000. Now, the reason this is done is because the subsidiary has recorded no liability or no expense whatsoever for this contingent liability. Right? But because we recorded it on the group financial statements, when the subsidiary has recorded this loss on the $50,000, we have actually increased the profit by $50,000 because we have already recognized this liability on the group's consolidation. And so we will offset the loss from the subsidiary. So effectively, it will be reducing that loss from $60,000 to $10,000. So we've increased the profit by $50,000. So then we'll have to pay 30% tax on that $50,000 amount. So we're increasing our tax expense by $15,000. Now, we'll then credit our settlement expense by $60,000. So the subsidiary recognized an expense on settlement of $60,000. So they would have debit the expense. But what we want to do is we want to tell them, no, on consolidation, we've already recognized this liability. So we want to completely offset any expense you recognized. But because the settlement cost us $10,000 more than we were expecting, we recorded a loss on settlement of $10,000 to make sure that we actually do record a $10,000 loss through our P&L. So the easiest way I like to think about it is the debit of the BCVR and the income tax expense represents the original $50,000 of equity that we reduced, right? Or is representative of the original $50,000 liability. So the BCVR is always going to be the $35,000 amount, and you can see the amount of the DTA has turned into the income tax expense. So I like to associate them with the original increase in the liability. That's nice and easy. And then you'll always be offsetting the settlement expense from the subsidiary. But then you'll either debit if there's a loss on settlement to make sure that you recognize that $10,000 loss, or you'll credit if there's a gain on settlement to recognize that gain. But you see what we've done, the subsidiary recognized the $60,000 debit expense. We've offset it with a $60,000 credit. That has a net zero impact on equity. But we know that there was the loss, i.e. it cost us $10,000 more than we expected. So we reduced equity by $10,000 here. We've reduced equity in the BCVR by $35,000, and we've reduced equity by the $15,000 from income tax expense. So if you add these three numbers up, they add up to $60,000 reduction in equity. Guess how much the settlement expense was? $60,000. So that's the way it kind of flows through there. Okay, so 30 June 2018 is the year after settlement. So what we do, we'll debit our BCVR because by increasing the liability originally, the owners of the company always had a reduction of $35,000 in equity, so that will always remain. All right, and then we will credit retained earnings, opening balance by $35,000. Now, the reason this is because if you look at this entry back over here, we made an adjustment to reduce equity. Sorry, my bad. We made an adjustment here with the credit to increase equity by $60,000. We made the two adjustments here to decrease equity, which add up to $25,000. So the net of those two, the $60,000 minus the $15,000 minus the $10,000, it adds up to a credit impact of $35,000 on retained earnings. And because of all of these expense accounts are closed to retained earnings at the end of the year, we need to make the adjustment to the opening balance of retained earnings. Okay, so I hope the video was useful. Just a couple of notes on contingent liabilities, that they are not recorded by the subsidiary. However, when you consolidate on the group, you will record contingent liabilities which are present. So they are present obligations arising from something in the past or a legal contract. So for example, our bank guarantee is a present obligation because you are obligated currently to pay that amount if the other person on the loan is not able to pay it. That's a present obligation of yours. You're not possibly obligated to it. You are 100% obligated to pay that amount no matter, if the other person doesn't pay. You're not, so an example of a possible obligation, say, would be you're currently in a court case and you're not sure if the case is going to go your way or not. And so if you're ordered to pay $1 million in the next, say, in 10 months down the track, that wouldn't be ideal, but it's a possible obligation. You're not sure if that's going to happen or not, so that's not recorded. Another note, so the fair value of this liability needs to be able to be measured reliably for you to record it. And so it's only the present liabilities that we are going to record. We don't record possible liabilities. So I hope the video was useful.